Welcome to the class 15 friends. In the last video, we have discussed the difference between the primary security and collateral security. We have also read about the different types of securities that are acceptable as collateral securities in the banks or the NBFCs. Today's video is very important for you to understand as a credit manager or a sales manager or as a borrower. Which collateral security? I am talking about only the collateral securities that we have discussed here: residential, commercial, industrial, plot, FDs, LICs, debt mutual funds, shares, PPF. I am talking about them only. Which collateral security is widely accepted? I mean to say, which out of these securities, which property, which type of security is the one that banks are more interested to take? That gives more comfort to the banks. I am talking about this in this video, right? So I have divided these collateral securities in two parts. First one is the property. Like the residential, commercial, industrial, plot, right? These four types are the properties of the borrower, right? So the other one is the others category. In other category, I have divided it into two parts: a security with no risk at all for the banks, a security with low and medium risk, right? So let us discuss about the properties, that is residential, commercial, industrial, and land, vacant plot, right? So these properties, friends, these properties can be of four categories. These properties can be of four categories. Of course, this is not applicable for plot of land. This is applicable only for residential, industrial, and commercial properties. We can categorize them into four parts. First is the self-occupied. First one is the self-occupied. By self-occupied, we mean that your borrower and his immediate family are actually using this property for them. They are actually using this property for their living, for their business, for their industry, for their factory. They are the one who are actually using this property. This is called self-occupied. So for residential property, we write the word SORP. SORP means self-occupied residential property. For commercial property, we write the word SOCP, self-occupied commercial property. And industrial property, we write the word SOIP, self-occupied industrial property. Of course, this is not actually applicable for the vacant land part, right? So first category is self-occupied. The second category is vacant. You are taking security of residential property, commercial property, industrial property, but this property is vacant at site. No one is sitting in this property, no one is using that property. The site is totally empty, the building is totally empty, no one is using it. This is called the vacant property, right? The third category is the rented property. The residential, commercial, or industrial property is given on rent to the third party. Somebody else is using that property for their own comfort, for their own business or residence. That is called the third category, rented category. The fourth one is the under construction category. Under construction category means the property is under construction and it is half constructed, or maybe the construction level is 20% complete, 30% complete, 40% complete, right? So under construction property, the construction is ongoing on that property. Property is not fully complete for use at the moment. The fourth category is under construction property. So friends, always remember this. I have written that in a particular serial order. These categories are only for residential, commercial, and industrial, not applicable for vacant land, obviously. So I have written them in the order of their risk. If the property is self-occupied and property is residential, commercial, or industrial, but it is self-occupied, then the risk level is low for the bank. Why the risk level is low? Because the borrower is itself using that property for his residence, for making his living, for doing his business, and he has emotional connection with that property. He has interest in that property. He has links with various neighbors around that property. And in case if he defaults in repayment of the loan and banks goes to take the possession of that property, then he may try to avoid giving possession to the bank. He may think that if he gives the possession to the bank, he may live, he may have to endure his loss in his business. He Where will his family goes if the bank take the possession of his residence? What will be the view of the neighbors? What will the neighbors say about the borrower, that the borrower has not repaid the loan? Like they will talk such negative things about them. So he will have a certain type of emotional connection in the self-occupied properties, and he may try to avoid giving the possession, and he may think that instead of giving the possession, let me repay the loan to the bank, right? So in the self-occupied properties, the risk is comparatively on lower side. Risk is there, but is comparatively on lower side than the other categories. In vacant property category, the borrower obviously has lower interest level in vacant properties, hence the risk is a bit higher than the self-occupied properties. In rented properties, the risk is more than the vacant and self-occupied properties because the tenant is sitting there. In the laws in India, if the tenant is using that property, then in case the borrower defaults in repayment of the loan, then it is very hard to take possession of the property because tenant can refuse to leave the property, and out of human grounds the court may reject the bank's plea to take the possession of the property. That is why the rented properties are considered very risky to mortgage, to very risky to take as a collateral security in the banks. The fourth one, under construction, is the most riskiest of the categories. In under construction properties, the constructions are ongoing. The borrower is mortgaging you that property where the construction is not complete. It may so happen that after mortgaging the property, after taking the loan, the borrower does not complete the construction at all. The property remains half cooked, right? So the half cooked property actually is very hard to sell in the market. If the borrower defaults in the repayment of the loan, that half cooked property is very difficult, very difficult to be sold in the market by the banks. So the recovery becomes more difficult for the loan. Hence, as a fallback plan, such type of properties are usually avoided by the banks. But some banks have the policy that if the construction is 80 to 90% complete already, and this is vetted by their technical engineers of the bank, if the 80 to 90% of the construction is already complete in that property, then bank do not consider that a under construction property and treat them at par with self-occupied or vacant properties, right? So in property section, first you have to determine what is the status of occupancy of the property, whether self-occupied, vacant, rented, or under construction. So the risk goes upward as the category changes in that particular order only. The second thing you need to assess is the type of property offered to you, whether it is residential property, whether it is commercial, industrial, and or plot property. The risk increases in that particular order. In the plot category, the risk is higher. Industrial, the risk is bit less, and the risk is lower on the residential property part. Why is that so? This particular risk categorization is designed for particularly for Indian market, friends. In India, the residence is a more secure property. Why? Because borrower's family, his wife, his children are living in this property, and if a bank want to take possession of this property, then where will his family go? Where will the borrower will take his family? Because as a main runner of the family, he has a responsibility towards them. So residence is the most secured one for the banks. The commercial property is one where he is doing business. The bank, if want to take the possession of the commercial property, the borrower may think that, oh, let the commercial property go. What will happen? My business will go out of my hand, but I will still have my residence. We will stay in our residence. My business has gone. I will think about something else in the future. The borrower may be more free to let go of that property. Similarly, for industrial property, and he will be least bothered about the plot property, right? So, friends, if we combine the risk factor of these properties, if the property is self-occupied and residential, then the list is on minimum side because this is the lowest risk. This is the lowest risk. If you combine both of them, the risk is on lowest side. If you combine this, the risk is slightly on higher side. Similarly for this, similarly for this. And you have to apply this combo for these properties as well. For commercial properties that are self-occupied, risk is bit less but a bit higher than the residential property. Similarly for this and this. These are not applicable for plot properties. Plot properties are always considered risky properties. So that is why most of the banks and most of the financial institutions try to avoid funding standalone on plot. They ask the borrower to provide any built up property along with the plot if he wants to take the loan, right? So what are the other categories? The other categories that we have mentioned previously are FDs, LICs, debt mutual funds, shares, PPF, etc. So in other categories, there are some type of security where there is zero risk, no risk at all. The categories are FDs. FDs are very liquid securities. If you have given the FD of 20 lakh for a 20 lakh rupees loan, there is no risk at all. Once you have defaulted in the repayment of the loan, the bank easily can take charge of the FD and can easily recover full 20 lakh value out of that FD, right? Similarly for debt mutual funds, the mutual funds that have invested only in debt portion, because there is very lower chance of reduction in market value of the debt mutual funds in future. They are always rising consistently. So this is a least risky property. LIC surrender value have zero risk, no risk at all. PPF has no risk at all because these are kind of clients own money only, borrowers own money only. We can also add gold here as well. We can also add gold here as well. If the client has given gold as a security for taking the gold loan, then this is also a zero risk security, right? These securities are a lower risk or medium risk securities like shares, like other mutual funds that have invested in equity shares like that, right? Why they are lower and medium risk? Because there are high fluctuations in the prices of these securities. If the bank has taken the security of say 20 lakh shares, 20 lakh shares of say Infosys company, right? And so, for example, they have taken 2000 shares as a security into 1000 is the current market price. So if in future the market price suddenly falls from 1000 to 600, the bank, there will be significant reduction in the security value for the bank. So that is why, due to high fluctuations involved, these are considered a bit risky for the banks, right? So the categorization I have explained to you above are basically based on the emotional connect of the borrower that I have already explained, the marketability of the borrower, the which property has more marketability. This changes a lot about the risk perception of the banks. But I want to explain one more point here to you. I have explained that residential property, if self-occupied, then it is the least risky combination for the bank. But friends, you have to assess it as per the different situation for your loan. For example, if a residential property, which is self-occupied, is located in a such area which is a community dominant area, for example, community dominant area, where it is hard to take possession of these properties since the community get together to protect their friends. Community dominant area, or the approach road of the property, the street in which property is located is, for example, only 5 feet wide, 5 feet wide, only 5 feet wide road of the property in which only a cycle or a scooter can pass. Only one cycle or one scooter can pass, not even a two bicycles or two scooters can pass together, right? Then the marketability decreases very significantly for these type of properties. So you have to assess as per the situation of your borrower, what type of security has lower risk and what type of securities are having higher risk. So if this type of security is proposed to you, then you cannot say that the Ankush sir has suggested that the residential property with self-occupied has least risk. You have to assess from the point of view of marketability. You have to take that in mind, that how will you sell this property, how easily the property can be sold in the market in case the borrower defaults in the loan. That you have to keep in mind. Of course, the emotional connect of the borrower, you have to think about that also, but the marketability is the prime thing. It is the prime thing that you have to think about. If the borrower has given you such type of residential property and he has a industrial property in a very good government developed industrial area where the roads are 100 feet wide, and very popular industrial area where the very big corporates are located adjoining the industrial property of your borrower, then the industrial property may be having more marketability than this property, and you may prefer to take that industrial property for your security instead of taking that residential property for your security, right? So you have to assess this as per the situation, different loans, different borrowers. You have to take call basis the emotional connect, and primarily basis the marketability of the property. I hope I have made my point clear. I will meet you in the next video. Thank you very much.